Welcome to Buy, Hold, Sell. My name is Matthew Kidman, and today I have Simon Benuvre from Cadence Capital and Romano Sala-Tena from Katana Asset Management. Welcome, gentlemen. And today we're talking about the grocery industry. Slow moving, dull, that's what you think. Not the case. There's been an upheaval in the industry, new competitors, a lot more competition. Simon, I'll start with you. A couple of the incumbents, especially Woolworths and Metcash, have come under pressure from new entrants, Aldi, and the rejuvenation of Coles. Can you start with Woolworths? Where do you think they're at, and is there any upside there? It looks like value.
Okay, so Woolworths is probably trading on its cheapest PE it's been in a while. However, I think earnings are under significant pressure. It really started for Woolworths when Aldi entered the market, and Aldi are gaining more and more market share, and they're really a disruptor. So with Woolworths, I anticipate going forward their margins will be under pressure. They're going to have to discount more to maintain market share. I just want to say everyone's looking at the comparison of Tesco in the UK and thinking, is the same thing going to happen to Woolworths? So for me, the stock's trending down at the moment. Earnings are under pressure. Until we see some stability, I wouldn't go there. One more thing, in addition, they've got the Masters joint venture overhanging them as well, which is
a hardware problem as well. Romano, let's switch to Woolworths have got problems, but Metcash have had a lot more. It seems like its share price is down 70-odd%. They've been forced to sell assets. They're having an overhaul of their business.
Yeah, look, it's certainly very dynamic and fluid at the moment, isn't it? I guess the question we start is there a sustainable business that Metcash is operating? And if there is, what's it worth? Now, they've stabilised at around about 1,400 stores over the last few years. Sales, yes, on a like-for-like basis have declined, but the store numbers have pretty much stabilised. So we think there is a long-term place for the independent niche grocery. In terms of valuation, we then say, well, what is it worth? At the moment, it's trading about 5.5 times with roughly a 20% EPS decline, so going to be about 6.5 times next year's earnings. Look, we see that as cheap. Balance sheet's starting to repair quite quickly. There is earnings declines which should probably bottom out around about 2017, and at that point we sit on around about 7 times earnings. So for those who can handle the risk, and notwithstanding there is downward pressure on the price, we do see good value now in Metcash.
Okay, let's move to Coles, which seems to have been resilient. Now we've got Aldi, and it seems like we've got Lidl, the second German operator, coming into the market, applying more pressure. Does Coles fend them off and grow from this point, or will it also come under pressure?
Look, I think the first thing you realise is Lidl hasn't even set up a store yet. It's going to be probably at least 3 years before we see any tangible impact on the likes of Coles and Woolworths there. I mean, Aldi's been going since 2001, so it's going to take some time there. And I think too, it's probably their model is more about attacking the market share that Aldi's got. So I think Aldi has got now to look at its back as opposed to say Woolworths and Coles.
So they might step on each other's toes.
Look, I think somewhat, yeah, definitely. And I think for us, we sit on the Coles front, we say, well, what are you prepared to pay? If you assume that Coles is now ex-growth, what are you prepared to pay for a business that's ex-growth? And that's the question that we spend our time on.
And Simon, what about Coles? Do you think it can get through this period of upheaval, or has it gone ex-growth and it's heading the same way as we've seen Woolworths the last 18 months?
I'd probably back Coles more than I would Woolworths. The thing with Woolworths is it was coming from a sector-leading position with global leading margins, 7 or 8% EBIT margins. So, whereas Coles has come in the other way, it's in a turnaround phase and it's trying to go where Woolies is at the moment. So, I think though the whole sector will be under a bit of pressure in terms of you've seen from a couple of years ago to now the growth expectations for Coles have been pulled back, obviously as well for Woolworths as well. So I just think in terms of growth, the growth rate's going to come up for Coles. I still expect them to do okay and better than Woolworths, but just not as well as what they were a couple of years ago.
So if you're going to be in the sector, what stock would you be in?
Okay, so for me, I actually wouldn't be in the consumer staples sector, but if I were, I'd buy Wesfarmers, and that's purely because it's a diversified business. So you've got Coles, which will do okay, won't do brilliantly, but they've obviously got other industrial businesses that come with the package.
Romano, you've talked about valuation. What's the best pick from a value point of view?
From a value point of view, clearly Metcash, but there's also a lot of volatility and more risk that goes with that. I think if you look at Wesfarmers, yet Bunnings thrown in, it's probably the best retail experience, or very close to, in Australia. So we're forecasting about 9 to 10 EPS growth over the next 2 years. You're paying a bit more for it, 7.5 times, let's just say 14 for Woolworths, but I think it's probably justified. So I'd probably go Metcash valuation, Wesfarmers second, and Woolworths I'd work out what it's worth on a yield basis.
There you have it. You might have to look west to buy your groceries. Thank you.